You're listening to the Be Better Off Show by Kelly+Partners.
Well, good morning and welcome to the Be Better Off Show, where we find great Australians to come and talk to us about being healthier, wealthier and wiser. And today we have Australia's most acclaimed chief economist at Westpac Banking Corporation. Not only is he only just beyond 21, but in those few years, he's acquired so much wisdom. I've never been to a presentation I haven't thoroughly enjoyed, learned an enormous amount from, and benefited hugely. So welcome to Bill Evans. I'm going to hand over to Bill and guys and girls tuning in, have a listen, and then we'll take some questions at the end. I cannot be more pleased to have you with us today, Bill, and genuinely humbled that you've made the time for us. Welcome.
Thanks a lot, Brett. Okay, so let's start by looking at the short-term outlook for the economy. So you wouldn't be surprised that in the September quarter, we're expecting that the economy actually contracted by 4%. You know, if you've got the two major cities in lockdown, Melbourne from the 8th of August and Sydney, of course, for the whole of the September quarter, which is July, August, September. We've got New South Wales contracting by 8%. So you can see that level of 100 there in June drops to, for New South Wales, drops to a little over 91. So that's nearly a 9% contraction. Victoria drops to about 94. So that's a 6% contraction. And the rest of the country sails through. So, however, with a 7.5% recovery in the economy in next year, will it still end up well ahead of where we were in June 2021? And I expect that by the end of June, by the end of next year, the rest of the New South Wales economy will be up 3.3%, only 3.8% on June 2021. Victoria will be up 4.4%, the rest of the country up 5.4%. So I'm expecting a really strong recovery next year, but it's obviously based upon a number of assumptions, and the uncertainty this time around is much greater than in previous recoveries, because we have the dimension of the health issue, and we also have the issue around supply restrictions, both in the labour market and in the goods market. Okay, one of the ways we measure what's going on in the economy is through our card tracker. So this gives you the turnover in all our credit and debit card businesses for the whole of the Westpac group. So it's millions of transactions. And when the index is below 100, it means the growth rate is behind where it was before COVID. And when it's above 100, it means it's above the pre-COVID growth rate. So some interesting things there. If you look at Western Australia, that's remained really solid at a 105, so 5 percentage points above the pre-COVID growth rate, which itself was about 4%. Queensland has held up really well. It had some dips with their lockdowns. But then if you look at the purple line, which is the most disturbing one for Victoria, really so many lockdowns and so many ups and downs that we've seen. And at the moment, of course, very much in the down phase. And then New South Wales, that came down well before Victoria, but remains in the doldrums. So at the moment, our card tracker is telling us that spending has been very badly affected by the lockdowns, as you would expect. And it can give us a bit of a general feel for what's happening to the overall consumer spending in the economy. So this sort of gives you a feel for how the card tracker maps against the actual consumption numbers in the economy. So the red bar is the growth in the card tracker and the black bar is consumption. So it is really confirming that, you know, what we've seen on the card tracker, almost a 6% fall in the September quarter. So it really is confirming a big hit to consumption in the September quarter. What we want to do is that we've got to avoid what's happening in the US, where if you look at the hospitalisations in the top 10 states, that they're the ones with the highest level of vaccination, around 60% of the population, which is about 75% of the adults. Their hospitalisations are around 200 per million, but the weakest of the states, the southern states, their vaccination rates are only 43% of the population, which is a little over 55% of the adult population, and their hospitalisations are almost 3 times. So what you get there is that you get an economy where parts of the economy are just not dealing at all well with the virus, and there's a risk of a spillover into the rest of the country. So for Australia, we want to get uniform success on vaccination. We don't want to have a situation where certain parts of the economy are lagging dramatically behind other parts. So our tracking at the moment, if you look at the red line there, that's New South Wales. So we're expecting New South Wales to get to that 80% of adults by the middle of October, and Victoria by the end of October, and then Queensland and Western Australia middle of November, late November. My worry is that those Queensland and Western Australia numbers start to lag behind because of complacency, given that they're open and they're not sort of affected by the need to get vaccinated to free yourself up. So the worry there is that we end up with something like the US, but in Australia, what would happen is that the laggard states would just close their borders and say, well, you know, we've got low vaccination rates, we're vulnerable, we can't afford to let the other states that have high numbers but are highly vaccinated in. So you've really got to be cheering on Queensland and Western Australia getting over those key target levels. Where we do get some comfort is what we've seen overseas in terms of hospitalisations. So hospitalisations are what it's all about. You know, as long as you can get to a point where hospitalisations are stabilising at reasonably levels that can be maintained and not overwhelm the hospital system, then you can keep going. So what we've seen with the UK, Europe, it's the so-called Big Four, France, Germany, Italy, and Spain, and Canada, is that once you get to those population vaccination rates of between 65 and 70, which is around 80% adult, you do stabilise. So at the moment, New South Wales is only 43%, and those hospitalisation ratios are heading up. So you haven't been able to stabilise that yet. But the overseas experience is at around 80, you're in good shape. Now, there's one difference between us and those overseas countries, and that's that those countries have got a high degree of people who have already been infected and are therefore immune without vaccination. So I think we need to be at 90% rather than 80 in order to be totally confident that we can stabilise the pressure on the hospital system. And there's no reason why we can't get there. If you look at the weekly percent of the population that are receiving a second dose, so you see New South Wales there on a tear, and Australia is still holding up pretty well. Whereas in the US and the US has stabilised and the UK has come down, but they're coming down from very high levels before. So what we watch really closely is that we have to maintain that pace, and if we can maintain that pace, we'll get to the 80 and get through it. The Australian pace is lifted, but as part of it's reflected the commitment in New South Wales and Victoria. One of the reasons why I'm still optimistic about the economy is if you look at the right-hand panel there, which is the daily share of eligible population getting vaccinated. So back in June, that was about 0.5%, and the economy was looking good, 0.5%. It was open, great, but the 0.5% wasn't good enough. It wasn't good enough to get to the 80 and the 90 that we need. So the side effect of the lockdowns has been that 0.5% has lifted to almost 1.5%. So the lockdown, clearly there's been a lift in supply, but the lockdowns have been really important in lifting that proportion of the population that gets jabbed every day from 0.5% to 1.3% and stabilising at that level. So that's actually been the great benefit of the lockdowns, that you've lifted that rate of vaccination per day. You've almost trebled it. Now, part of it is the increase in supply of Pfizer and Moderna, but a lot of it has been the commitment by people saying, well, this is our road out to freedom. When we seen some surveys on those people that are not vaccinated, left-hand panel is for Australia. So 60% of the people that were not vaccinated gave the reason that they were hesitant about AstraZeneca. Well, what's happened, of course, is that hesitancy has started to fade as the hysterical publicity about blood clots and that has faded away, and as the availability of other vaccines has come through. So next time I see that survey, I would expect that the proportion of AstraZeneca hesitancy will be way down, and we will be really making inroads into those people who are hesitant to get vaccinated. Whereas if you take the US, there's a couple of components there. 40% of those that are not vaccinated have said they will never get vaccinated, and 20% have said they're highly unlikely. So you've got a real hardcore in the US that won't get vaccinated. We're in a much, much better position than the US to get a sustainable solution to this problem because of this commitment to vaccination. Now, I understand there's health issues about another strain and about the wearing off of the effect of a vaccine and therefore the need for boosters. Understand those two things. But at least we've got the commitment to get the vaccination, which isn't the case in the US for a hardcore group, indicating that we can do much better than them. Yeah, and when we ask people about their willingness to get vaccinated, the red bar is the proportion of no's. So back in April, May, when there was that hesitancy, it was up at nearly 20%. It's now down to 10%. I think it can get even lower than that as you have the passports, as you have governments highlighting the advantages of being vaccinated. So I think we can get that number way down, and that puts us on the path to try and get that 90% success rate. And if we do that, then if you look at our projections for Australia, the black line, that's way behind at the moment relative to the US, but that US line is much flatter. So we can actually go through the US and we can get to that 90% by the end of the year or early next year. And I think that's the foundation we need to get that 7% growth next year. I think much less than that, you're going to have hesitancy. If you only get to 80% of adults, that's still 4 million adults that are wandering around that are unprotected. And the data we see is that between 5 and 10% of people who contract the illness end up in hospital. So I think we're too vulnerable at 80%. Now, I know that New South Wales and Victoria are going to reopen at 80%, but I'm expecting that the commitment to continue to get vaccinated will get us to that 90% when we can feel a lot more comfortable. Let me now get on to some forecasts. So we expect that the RBA will start raising rates in the first quarter of 2023, and that'll be in response to the 7.5% growth rate we're going to get this year. The bond rates are too low at the moment, so we expect that the bond rates that actually overnight, the US bond rate's now up at about 1.43 from that 1.36 I've given you there. And they're heading, I think, to 2% plus. And the US Federal Reserve will also start raising their rates at the end of 2022. I think we got some further support for that view from the chairman yesterday. And I think Australia will peak out at about 1.25% at the end of 2024, and the federal funds rate about 1.625 at the end of 2024. So a fairly flat interest rate profile. And I'll give you the reasons why I'm expecting that. On the Aussie dollar, 73.5 this morning, 73, around about there. It's been pretty resilient to that Evergrande story. People were calling it way below the 72s when Evergrande was at the Evergrande coverage was at its worst a few days ago. It's held in pretty well. And if we can get that 90% vaccination, we are going to be the poster child of the world in terms of our ability to deal with the virus, as we were in 2020. 2021, of course, we were the villain, and the Aussie dollar fell from 79 cents down to 71 cents at one point. So I'm pretty optimistic that the Aussie can remain on an upward glide to 75 at the end of the year, 78 next year. Bear in mind, next year I see a strong world economy, and while we've got commodity prices falling further, the commodity price Aussie dollar link at the moment is pretty tenuous, because if the commodity prices were the driver, then Aussie would be in the 80s now, and I'll show you why. So why do I think the RBA can raise rates in 2023 early? I think we're going to get an unemployment rate down to 4% by the end of the year, end of next year. You know, it got down to 4.5 before Delta, so it fell from 7.5 to 4.5 in the last year, in the year between July 2020 and June 2021. Now, part of that was demand, but part of it was supply. So a lack of available workers. We've lost about 150,000 foreign students and about 100,000 holiday workers, short-term holiday workers, and about 80,000 skilled workers, all because of the closure of the borders. And I don't see them coming back quickly when we reopen those foreign borders around the middle of next year. So that supply constraint on workers is going to be operating through 2022, but demand will be picking up. If we're growing at 7.5% and we're reopening, we'll see what we saw pre-Delta, and we'll see a similar sort of a story where the unemployment rate fell from 7.5 to 4.5. So if we go into this year at 5.4, and that might even be lower now, and we get that 7.5% growth rate, then you're going to be scrambling to find workers, I believe, and the unemployment rate can go to 4 or even lower over the course of next year. And that's, of course, I believe will be associated with some upward pressure on wages. So some of the stories on wages and inflation: full employment by late 2022. The last time we had 4% unemployment, wages growth got to 4%. Now, at the moment it's running at 1.7, but once we drop out the bad quarter, the June quarter last year, it'll be up around 2.2. And I feel that we will start to see some of that upward pressure. Other things that might happen: if there was a change of government, a Labor government would try and boost the minimum wage by more than, say, the current number of about 3%. Those supply issues will boost inflation as well. You've got these imported durable goods supply chain disruptions. Shipping costs are up by a factor of 5. So anyone that's landing imported durable goods is really paying that big cost, and there's shortages everywhere at the moment. Motor vehicles is probably the best example. So I think that's going to boost prices as well. And then you've got the building materials story, timber in particular, and a lot of our timber is imported, and that's facing the 5 times increase in container shipping costs. Labour shortages. Not only have you got the closed foreign borders, but you've also got this issue about vaccination. So how much if I'm saying about 10% of the population will remain unvaccinated, how does that affect their ability to join the workforce? You know, we don't know the answer to that. We don't know whether this will, at the edge, will also subtract from the availability of labour. And there's a real risk that inflation might indeed surprise to the upside. So why do I think rates will peak out at 1.25? Well, I think the dominant story is going to be this boom in household debt. You know, we've got these interest rates at these record lows. We're starting to see lending really taking off. We've seen house prices up nearly 20% over the last year and no rate hike in sight. We had the Reserve Bank governor last week tell us he's not going to raise rates until 2024. And if you look at his forecasts, it's going to be 2024 at the second half of the year, not in the first half of the year. So people are responding to that. So household debt's going to continue to boom. We think housing credit could be growing at around 11% 6-month annualized pace by the first half of next year. So that means when you do start to raise rates, people are going to squeal. There's going to be a lot of pain out there. I don't think you need to push them much more to much more than about 1.25%. That'll get that debt servicing ratio back to those previous peaks that we saw in 2009 and in 17-18. You don't want to go back to that peak in 07-08. That's when we had the 4% wages growth and the RBA just went a bit crazy. I think they'll be a lot more balanced on that, but you are. So the peak will be low, but the impact upon the borrower will still be quite significant. With regard to the US, bear in mind what happened in 2018, and this is a comment on equity markets. So you can see what the see the circle area there, what the Federal Reserve was doing in the lead up to 2018 when they finally realised that they could start normalising interest rates. So they pushed the rate up to 2.375, and then the share market took fright and sold off dramatically. And then very quickly they slashed the rate. So what I'm saying is that the US Federal Reserve is so sensitive to the equity market, which does provide you with some inbuilt support. And we saw it this week. So there was a debate this week as to whether they would, whether they'd announce an actual date for the tapering of their bond purchases. And my argument was always, once we saw the Evergrande crisis in the share market, they were going to back off, and they'd talk about it, but they wouldn't give a date, and that's what happened. So what if we do see a major sell-off, then that will affect the way the Federal Reserve operates, because the US economy is really, really strong. This is the best measure of what's happening in their labour market, this red line here. So this is saying that there's 10 million job openings at the moment. Now, if you look at what we've seen in the past, the average is around 6. So there's plenty of demand for jobs. One of the reasons why you didn't get a big jobs number last time was because workers are still nervous about going out in those areas that have got the low vaccination rates. They're nervous about going out in the community looking for jobs. Schools are closed, but unemployment benefits are going to be finished in the next couple of months. So I think you're going to see a really strong US labour market. And the Federal Reserve has said that they've got two objectives, inflation and the labour market. Inflation's already been achieved. They've got quite high inflation, reflecting all these supply restrictions. They want a 4% unemployment rate. They've got it down to 5.4% really quickly. So I don't think there's much doubt that they will be getting to a point next year where they can start raising interest rates. And remember, what the Federal Reserve does is very much the leader of what happens everywhere. So with the RBA saying, oh no, well, Federal Reserve goes up in late 2022, we'll wait till second half of 2024, it can be very hard for them to do that in a world where others are lifting. So the Bank of England overnight indicated they're bringing forward their hike. As you know, New Zealand is expected to start hiking in a couple of weeks. The Bank of Canada is also expecting to go middle next year. So the tide is turning, but it'll always be led by the US. All right, so I painted a picture where bond rates go up to about 2%, which is still very low. So the black line there is the bond rate, and the other three are property yields. And so what you see is those yields on prime industrial, prime retail, prime office have all come down as the bond rates come down. So the question is, if the bond rate goes up, the bond rate goes up, can we expect to see a rise in those yields? I suspect not, because look at the gap that's opened up between the two of them. So I think what will happen is that those yields will go sideways, and the increase in the bond rate from 1.2, 1.3 up to a bit over 2 will be absorbed into the market. You can see there's already some relative weakness. So prime retail yields have gone up a little and industrial have come down. We understand that's COVID related, people buying online, etc., and less people, and the impact that shopping centres are having. But the overall picture, I don't see a sharp rise in commercial property yields, despite the fact that I'm expecting bond rates to rise. But the other thing you have to remember is that this is a permanent change on remote working. We're not going back to the previous model. So here's a survey from the Bureau of Statistics, where the blue line, the blue bar, is the proportion of businesses that had remote working facilities before COVID. So for small business, about 20%. For large, it was about 45%. That's the blue. The first green is what happened after COVID hit. So small business went from 20 to 40, big business went from 45 up to about 85. And the light green is where people think will be the long term, where it'll settle long term. So small business will go from 20 to 30, big business will go from 45 up to about 65%. So it's going to be a permanent change. We are going to permanently see many, many more businesses allowing remote working. And there will be a slight moderation from what we're seeing at the moment. But on this survey, where we are today, as at April, the long-term expectations are pretty similar. So in other words, get used to it, because whatever we're seeing now is likely to be a long-term trend. On the Aussie dollar, as I said to you, if you look at commodities, the blue line, against the Aussie dollar, the brown line, see where commodities were and the Aussie dollar was back in 2012. Well, commodities are still around there. They've fallen. Iron ore's fallen, but coal has remained incredibly strong. But we're expecting further falls. But the gap between Aussie and those commodities is so wide, I think you can have those commodities falling. Other things will be supporting us as the market starts to see us raising rates in early 2023, as we do very well on our growth rate and on our vaccination rates, as the world feels like a better place, as we just get more and more and more vaccinations into the world economy. I think that's going to support a risk-on currency like the Aussie dollar. If I'm wrong and the world collapse, we get another strain, a different strain that's resistant to the current vaccines, let's hope that doesn't happen. But if I'm wrong on that, China makes a big mistake in terms of what their policy now, which is to try and rein back the property market. If I'm wrong on all of that, then you want to be in the US dollar, not the Aussie dollar. But at the moment, our central view is that the Aussie dollar will be the one that'll do the best. So this is the worry about China. So if you look at residential sales, they had a boom even stronger than any other property boom they've had in the past, with residential property sales growing at 150%. Now, the government said that's not sustainable. We don't want that sort of a model. So, of course, they started to restrict the credit availability, and Evergrande was right in the sights with their 300 billion of liabilities, extraordinary number. So the authorities have got this down. They've slowed it down. They've taken heat out of the market. If you try to do that in the West, you'd come undone, because contagion would spread quickly. Here, because all the major banks are owned by the government, and they say, well, you have to keep lending to this developer, etc. So they can control things a lot better. So I think Evergrande is going to have big issues, particularly for anyone who's holding their foreign bonds, their US dollar bonds. Equity investors, I think, will have problems. But I think, and maybe the banks will have to write off some loans to Evergrande, but I think the government will get in there to ensure that we have a soft landing on this. It's still early days and we're getting conflicting information daily, but we seem to have passed the really crisis point, although the government is denying the fact that they've assisted in the coupon payment this week, but they do have 669 million in coupons to pay this year. 669 million they have to find in cash. But they don't have any bonds maturing this year, but next year will be a different issue. So I think they've got time to work this out, but the bottom line is that the government has wanted to slow down that residential market. They're big users of iron ore, and that's the main reason why the iron ore price has really tanked down from over 200 down to 100. If you look at our exports to China a couple of years ago, 150 billion and only 65 of it was iron ore. And we had all LNG and gold and services, 18 billion. If you look at it today, outside iron ore, our exports to China have fallen from 70 billion to 20 billion. And things like coal, LNG, gold, cotton, copper, wine have just been smashed. So while our overall exports to the US are very strong because of iron ore, which is now 120 billion, and 2 years ago it was 60 billion, the rest of the exports, services of course have disappeared altogether, the foreign students and the tourists, and the other exports have been squeezed from 70 billion down to 40 billion, with coal coming off 12 billion, LNG 3 billion. So it's a pretty sad scene with the exception of iron ore. And as we know, iron ore's price has come off, has halved. So we do have real issues around our services. Even when the borders reopen, will the students come back? China's very much trying to expand those sectors of their economy that compete with imports. So stay and get your education in China, don't go overseas. Take your holidays domestically. They're doing all of those things, and we are right in the eye of the storm. So the thing about our trade with China now is that, yeah, it's very strong, it's big, it's up, but it's all iron ore based. And they would love to be able to find other sources of iron ore. They've got a mine in Guinea that they think can eventually give them about 20% of their needs. At the moment, Australia is around, of their foreign needs, we're about 70% and Brazil's about 30%. So they're trying really hard to lower their exposure to external iron ore from 90% to 50%. I don't think they'll do it, but we remain very vulnerable to any other sources of iron ore or any big downturn in their building picture. Business confidence, consumer confidence, big difference between this cycle and the previous one, and the alpha cycle. You can see that in the first lockdowns, business confidence collapsed to a -60, rebounded. This time, when we had the lockdowns, it collapsed to about a -10 and has stabilised. Consumer sentiment collapsed to about a 70 last time. This time, it held above 100 and has now stabilised again. So business and consumers are really dealing with this lockdown in terms of confidence a lot better because they can see the solution. They can see the solution through vaccinations. What it's doing is it's setting the platform for a very strong recovery once people are confident to get out and about. But I think, as I said, 80% is probably not going to be enough to establish that. That's why I see the strength coming in 2022 rather than the tail end of 2021, even on the current timetable of reopening early November. There are areas that I'm worried about. The support packages for the household sector look pretty good compared to JobKeeper. So with JobKeeper, you got $750 per week. If you weren't working, even though you're attached to your employer. This one, you get $750 if you lose 20 hours of work or more. It's paid directly through Centrelink rather than through the company. And that's big downside for the company. So a lot of businesses that would have kept their worker on anyway and would have paid them because the worker was being productive, they were servicing online, etc. But they got that direct subsidy from the government. So the business received that money rather than the worker, because the worker was going to be paid anyway. So business doesn't get that benefit this time around. So the household sector still gets the money. So I'm not as worried about them as I am about business. And I've looked long and hard in these state government support packages. So if New South Wales looks pretty good, JobSaver, you get 40% of the wage bill up to 100,000 if you've got a 30% down in turnover. There's a payroll tax subsidy and there's one-off payments. But Victoria, because it's been so volatile there, so many snap lockdowns, I can't see a stable policy like the JobSaver in Victoria. So you've seen hardship one-off packages, smaller than New South Wales, hospitality packages, this business cost assistance program, but it looks to be limited to 8,500 compared to the 100,000 New South Wales. So some of you may be more on top of these state government support packages for business than I am, but I've looked long and hard, and I get worried that small business in particular that isn't getting the benefit of JobKeeper is going to be more scarred through this process than we saw in the past. And then, of course, I look at company insolvencies. So the black line there, they've come down from 0.1 per 0.1 for employing businesses to 0.04. They've sort of halved since COVID. Now that doesn't make any sense. The economy contracted in the June quarter, it contracted in the September quarter. So obviously the support packages have been hiding a number of businesses, supporting them that would normally in any other normal period, the insolvencies would have been greater. So what it's telling me is that when we get into the recovery phase and the support packages are withdrawn, there's going to be a lagged lift in insolvencies. That's what we'll see next year. Now, it won't mean we can't get that 7.5% growth, but there will be pockets of pain as we go through next year. The big hope of the side is the household sector. They're the ones that have been getting their payments, and they're the ones who have accumulated a lot of cash. We see it in our own balance sheet, household deposits going through the roof. The savings rate got down to 10% in the June quarter before the lockdowns. But it's going to go back up to about 16% in the September quarter as people have been unable to spend but have been receiving support payments from the government. And why that is so important. So if you look at what happened in the June quarter, so the first bar looks at the increase in labour income, that's wages, about 3 billion. See the 3 billion there on the left-hand side? And then there was another increase of about $1 billion to get you up to 4 billion, but they received less social assistance because unemployment went down. So unemployment benefits fell and more tax was paid because more of them had jobs. So that was a bit of a wash. But what did support spending was that they didn't have to save as much because their savings rate was already so high. So some of them actually dipped into their savings, and others who normally saved less. So that gave them all that extra cash to go out and spend. And that supported the big lift in spending that we saw. So when you have that high savings rate, two things happen. One, those people that save normally save less, so they can spend more. And those that have accumulated savings can dip into their savings and spend more than their incomes grew by. And that's a hugely powerful dynamic going forward. So as long as they're able to spend the money and they're not locked up, that's going to provide a big lift to spending next year. Now, the worry might be about where the spending happens, because you can see spending on durables, cars, TVs, is up 14.7% pre-COVID. That's a lot. That's much more than you normally expect. You would normally expect that to be about 6%. And that, of course, is people being locked down and not being able to spend the money on services, so they go and spend it on durables. Let's buy a new TV, let's buy new bikes, etc. The other factor that's driving that is the closure of the foreign borders, because Australians spend 55 billion a year on foreign holidays, but foreigners only spend 25 billion in Australia on their holidays. So there's 55 billion there that's been locked up, ready to be released. And that's what's happened. So renovations and additions are up over 20%. Durables are strong. When you reopen the borders, that spending will start to lift out, to feed out into the world. But I think it's going to be a very slow process in terms of people responding to open foreign borders. The thing that has to come back, of course, is discretionary services, restaurants, etc. They were down 50% on pre-COVID. They've bounced back a lot, but there's still a long way for them to go. And that, of course, is where we'll see the big change over the next 12 months, because there's just so much pent-up demand for those sorts of services. But let me finally make a few comments about housing. So dwelling approvals have gone through the roof, and a part of that is due to the home builder program, but that's now starting to roll over. And if I'm right, and they're raising interest rates in the first quarter of 2023, you'll start to see those fixed mortgage rates rising. Now, at the moment, they're not. The Reserve Bank governor said they're not going up. So they're not rising at the moment. But as we move forward, I think you'll start to see that. And if I'm right, so, you know, a 3-year fixed rate of a bit over 2 now will end up at 4. It's almost a doubling of your interest payments. So if you've got a big debt and you're wanting to remain fixed, your interest payments are going to double, and that's going to be painful. And that's even only with that 1.25% cash rate. We're already starting to see different responses in our sentiment survey. So when we say is now a good time to buy a dwelling, that's collapsed. That's the red line. I think that's reflecting people getting nervous about affordability, about high prices. That's not a good time to buy because prices are too high. But when we say what's the outlook for house prices, that's at 8-year highs. So you've got one group going, yeah, prices are going up. Another group going, yeah, but I don't want to buy now because I think it's just unaffordable. But the red line affects first home buyers and upgraders, and the black line is the investor. And what we haven't seen yet is the investor really start to spread their wings. So if you look at new lending, the grey line is upgraders and the black line is first home buyers who are already leaving the market. And the red line, investors, are just getting going. So in the last 6 months, investors are up by 30% and the others up by about 5%. But you can see the starting point. Now, when investors have been the problem for the market in the past, back in 15 and 17, they were very close in terms of the level of new lending to upgraders. But now it's a massive gap. So the authorities that are looking at potentially having to intervene to slow this thing down, they won't be focusing on investors. And you watch the investors take advantage of that. Affordability is also starting to get squeezed, but this really reflects first home buyers. So it's your ability to raise a deposit. And the higher the number, the less affordable, because it's a higher proportion of your income. So 2 points. The first point is that very quickly we'll get back to those stretched affordability levels that we saw back in 17, 18. And secondly, regional affordability is just completely off the map in terms of being squeezed. We haven't seen that since pre-GFC, when cash rate was about 7.5%. So we know that we're seeing this working from home trend happening, but it's certainly shown up already in those regional prices. I suspect they can probably go further, but that's certainly really showed up at this stage. So this gives you a picture of the pace, 6-month pace of house price. You can see that for Sydney, it's the fastest pace we've ever seen. fastest ever seen. And we've got a central bank governor telling us that rates are going to remain at zero until the second half of 2024. Hey, how good is that? That's one hell of a bubble coming up. Brisbane is the other one that's really shown up this time. See, Brisbane was in the doldrums for a long while. It's really responding, and Melbourne's doing okay. All of them have slowed down a bit, but you would expect that, particularly Sydney and Melbourne, with the lockdown. In fact, I think the slowdown has been a lot less than I was expecting. So apartments haven't been doing as well as houses, and that's unusual. Normally, they move very closely together. But this time around, the growth in apartment prices has been much, much less than houses. Partly a COVID effect, I want more space, partly the student effect. So you can see foreign students, visa holders, back in March 2020, were around nearly 600,000. They're down to a bit over 400,000. So these people leaving or not leaving and not being replaced has put a big pressure on the high rise. And that's why unit prices haven't gone up by anywhere near as much. So the question is, what could happen from here? Well, if you look at what happened back in 1718, the blue line, you had a big fall in prices then. And they didn't raise rates. But what did happen was that the market was frightened of a Labor victory and the tax changes that were involved. The banks were frightened of the Royal Commission and cut back on their lending and had these incredibly tough lending guidelines. And the government put on macro-prudential controls. So you had a lot of factors happening. Next time around, the Labor Party doesn't have any tax policies like that. They've learnt their lesson. The banks are desperate to lend in the mortgage market. It's their best business. If you're funding yourself at 0.1 and you can lend the money out at 2, 2.5, that's the best business. That's the best banking you can have in the world. And so the banks are not going to be the way they were last time. They're going to be competing hard. And without rate hikes, which I think will happen without them, it'll be a very different story. So I think, and now that the macro-prudential, if that comes on, it's not going to be on against investors. You know, you're an investor and you've just gone through Evergrande. You say, gee, this equity market, that's not for me. I got these interest rates at zero for the next 3 years. I might go looking again. So I think if I'm wrong and they don't raise rates, you're going to have one hell of a boom. So these are our forecasts on the basis that they raise rates in the early 2023. So you get some more strength in 2022 in the first half of the year, and then zero in the second half. And then when they're raising rates, prices fall, but not precipitously. But in Sydney and Melbourne, which would be the overheated markets, you'd get that adjustment in prices. But if they don't raise rates, and if I'm wrong, and rates are on hold in 2023 and most of 2024, then it'll be a different story. You could have anything happening over that period. But then when they finally do go, look out. So some interesting dynamics that we're looking at the moment. But I've done my time. Now, has anyone got any questions?
Terrific, Bill. Really very, very interesting. Inflation, there's a lot of talk about inflation for those young people here who have never seen real inflation. What does that mean for our businesses, and what's
what's different this time is that you've got these supply disruptions. As I said, shipping costs, container shipping costs are up by a factor of 5 times. So if you're landing a container, you know, the shipping cost that used to be a detail is becoming quite a factor. And supply chains that people thought would have cleared by now are not. So people are starting to raise their inflation concern there because of the supply chain story, particularly motor vehicles, because the supply of global supply of chips have been affected, because factories have been locked down because of COVID, etc. So it's taking a lot longer for that to ease out. So that can continue. And then the same supply story comes through on wages, with the lack of workers, lack of available workers. We talked about the closed borders, and the new one that we don't know. I'm interested in whether there's a debate on whether we think it'll be a factor or not. This idea of you're not vaccinated, so you're no longer part of the workforce, and it's going to be, that sort of cuts out a certain group from the supply of workers that we haven't seen before. Now, maybe there'll be ways around it, and maybe 90% is being, the 90% will be even higher, but that's the other factor. So then when it gets into people's expectations, it starts to lift. So I don't think it's going to be dramatic, but I think it'll be enough to have those rates rising a lot earlier than the government's expecting.
And for services businesses and their prices, do you expect that businesses like ours would just put our prices up?
Depends on what you're getting in terms of your workers, because obviously most of your costs are labour related. If you feel that you're having trouble supporting the right worker, and you think that you need to raise wages to get them in, then that'll happen. Now, at the moment, the view is that businesses are still totally focused on costs, so there's no way they'll ever raise wages. And what we haven't seen yet is a big evidence of like mobility, so people changing jobs. Once that starts, then it's all over. That's when wages take off. Once people feel confident enough to change jobs for more money, then to keep your best people, you have to raise your wages. So we haven't seen that yet, but the risk is this time around that you will, with strong demand and that ongoing limit on supply. What are you seeing? What are you and your customers seeing on that?
We think that that finding people is tight, mainly because people aren't changing jobs.
Yeah.
Because it's difficult to change a job in this environment, in that you don't know, you're working from home, you don't know people that you might otherwise be working with in a new situation. So changing jobs, I think, is relatively hard at the moment. And a lot of businesses aren't doing that well. So I think there's some reticence there. I think the other big one you've touched on were housing prices. In Sydney, we seem to see like very two-speed economy, in that you're seeing the beaches in the eastern suburbs explode in value, northern beaches, etc., explode in value. So it does appear that the wealthy amongst our clients are becoming dramatically more wealthy. How do you see that playing out in house prices in a place in Sydney where it seems like you've got two economies?
Certainly, as you continue to have zero interest rates, people can borrow a lot of money. So that's sort of supporting equity markets. But I wasn't aware that prices are not doing well outside the eastern suburbs now. I thought it was right across the city.
They are doing well, but the people that we see in the client base taking advantage of that are people that can access borrowing easy. And so first home buyers and younger people who struggle to get deposits, then really, I don't see them as equal participants in that explosion.
Yeah, and that can only be exacerbated.
If you were looking at selling, would you be looking at selling now or maybe the first half of next year?
Look, depends whether I'm right or not about interest rates, Peter.
Yeah.
If I'm wrong and the Reserve Bank governor's right, and he sits on the rates until second half of 2024, I wouldn't be selling.
Okay.
Because there's going to be, there'll be another up leg for sure if people felt that interest rates were going to be that attractive for so much longer.
All right. And with the Reserve Bank, the governor there, if you were wrong, sorry, just going back, I'm just trying to remember what you said about the interest rates. What do you think would happen if you were wrong as far as when they would raise them? Was that at the back of 2022 or beginning of 23?
So by the time you get to 2024 and you've got another big lift in debt because you've gone for 2 more years with zero rates.
Yeah.
So the sensitivity of the economy will be even greater. But the problem then is that if inflation then takes off, you have one instrument to fight the inflation, interest rates. You've got a big problem because the economy will be so sensitive to the interest rates. Anything you do will do a lot of damage, but it'll take time to work through. So you might over tighten. And so that's what you don't want to see. You don't want to get to a point where the economy is so sensitive to interest rates because of such a build-up in debt. And then you run into an inflation issue and you want to deal with it and you over tighten.
Okay, thanks very much. Thank you.
Bill, have you heard any prediction on when the supply chain will start to clear up and get back to a more normal level?
Oh, look, people have been surprised that it hasn't happened earlier. At the moment, the view is 2022, but of course, if China's still trying to have zero cases on COVID, which would appear to be unachievable, but they seem to be getting there. Every time they have an outbreak, they'll close their ports again. So it's really, I think the most important point is when does China feel that how does China deal with the COVID story? Because if they're one of the few left that feel that they can get zeros, and while they're aiming at zero, I think you're going to have this on-off style management around supply chains coming out of China as they shut things down so quickly. I heard where a few months ago there was their third largest port was closed for 3 days with 1 case. So you could see that these disruptions, specifically related to China, who's targeting zero cases, could go on for some time. That's what people are starting to think. So yesterday, for instance, in the Federal Reserve, when they put out their inflation forecasts, they were all higher. And the time at which things were going to get back to normal was pushed out again.
Thank you so much for your time, guys. I hope everyone enjoyed that and learned something. I've never spent any time with Bill where I didn't learn a lot. That's incredibly interesting. Mate, thanks so much for making the time for us. I really appreciate it. And have a great day.
My pleasure.
Thanks everybody.
Bye.
Thanks for listening to the Be Better Off Show. If you enjoyed this episode, don't forget to rate and review on Apple Podcasts.
Have a great day.